Reliance's latest results are out, and honestly, they're a bit of a head-scratcher. On one hand, revenue is up, but on the other, profits have absolutely tanked. So, in this explainer, we're going to dig into the numbers and figure out the real story behind this huge contradiction.
And this is the central question, isn't it? It's the puzzle everyone's trying to solve. On the surface, things look okay. Sales are climbing. But that profit number, wow, it tells a completely different and frankly, a much more worrying story. How on earth does that happen?
That's exactly what we're going to do. We are going to push past those top-line numbers, get right into the nitty-gritty of how each part of the business is doing, and uncover the real story of a company that is going through a massive change.
Okay, first things first. Let's rip the Band-Aid off and start with the bad news. The number that caught pretty much everyone off guard and set a really nervous tone for the whole earnings release.
And here it is, a net profit of just under 17,000 crore rupees. Now, that's a drop of 12.5% from last year, and it's a huge miss from what the market was expecting, which was something closer to 20,000 crore. I mean, imagine you were expecting a 20% raise at work and you got to pay cut instead. That's the kind of shock we're talking about here.
And here's how the analysts are putting it, and they are not mincing words. It's not just that the profit number was low, it's that the quality of those earnings is seen as weak. And that points to a much deeper problem with profitability, especially in the company's main business.
So where did all that weakness come from? Well, it starts with Reliance's traditional cash engine, its bread and butter, the oil-to-chemicals business, or what they call O2C.
And this chart, it just lays the problem bare, doesn't it? You can see a major drop in the money coming from the O2C segment. For decades, this business has been the super reliable workhorse that funded everything else. And now, well, it looks like it's sputtering.
So what went so wrong? You could call it a perfect storm of things happening all at once. You've got rising crude oil and shipping costs squeezing them. Then you have export restrictions adding even more pressure. And of course, geopolitical chaos in the Middle East created a ton of volatility. On top of all that, the cost of their raw materials alone shot up 20% in a year. These are some powerful headwinds, and a lot of them are pretty much out of the company's control.
But wait, that's only one side of the story. Because while that old engine was sputtering, a brand new one was absolutely roaring to life, and that's Jio Platforms.
Talk about a complete 180. In total contrast to the O2C business, Jio's profit jumped by a really healthy 13% year over year. This isn't just random growth, it's a powerful signal of where this company's future is headed.
And when you dig into the details here, it gets even more interesting. Profit and revenue are both looking great. But look at that ARPU, the average revenue per user. It's at 214 rupees. This shows that Jio actually has real pricing power, and it's getting better and better at making money from its massive user base of over 52 crore subscribers. That is a very, very strong sign.
Okay, so we've got two totally different stories playing out at the same time. The old business is struggling, while the new business is booming. So what happens when you smash them together?
And here's the reality check, the big picture idea you need to grasp. Reliance isn't just an oil company anymore. It's a company stuck right in the middle of a massive and, yeah, sometimes bumpy transition. It's shifting its whole identity from an old-school oil powerhouse to a new economy giant in digital and retail. And this transition? That is the key to understanding why its overall revenue can go up while its profits get squeezed.
So understanding this big shift is one thing, but what does it actually mean if you're looking at this as an investment? Let's break down the verdict from the source material.
You know, there's this idea that floats around about a company this huge, this important, that it's just always a safe bet. But is that really the right way to think about it, especially right now?
Well, the analysis we're drawing from has a pretty direct answer to that. Nope. Believing it's always a safe buy is just lazy thinking. The reality is way more complicated. It's this giant company with parts that are moving in opposite directions, where the strength in one area can totally hide the weakness in another.
And this really breaks down the whole debate, the push and pull of investing in Reliance right now. The case for buying is super clear. Jio is a compounding machine, the retail business is a massive long-term bet on India's consumers, and a future IPO could unlock a ton of value. But the case against it is just as strong. The core O2C business is getting weaker, margins are at risk, the stock isn't exactly cheap, and that whole new energy business is still more of a promise than a reality.
So given all that, what's the actual call? Well, it's not a simple buy or sell. It's way more nuanced and really depends on how long you're willing to wait. In the short term, say the next 6 months, with this weak report, the advice is to just hold what you have or avoid buying more.
Over the medium term, the strategy is to maybe pick some up if the price dips. But if you're looking long-term, 3 to 5 years out, the belief in that big transition makes it a buy, but a staggered one. And that really brings us to the final, crucial takeaway from all this. Reliance today isn't a stock for a quick in-and-out trade. It's a stock for strategic accumulation, something you build a position in because you believe in its long-term transformation. So the real question for any investor is this: is this quarter stumble just a crack in that transformation story, or is it actually a golden opportunity to buy into that long-term vision at a much better price?